Hello out there in video land. This is Bob. I am making up a video here on chapter 4 about adjusting journal entries. And before we look at the PowerPoint and get into a couple of other things, let me point out that adjusting journal entries are done by all companies in all kinds of volumes. Adjusting journal entries are done only at the end of the month after we have prepared a preliminary trial balance. We then go through that trial balance and we look for possible unrecorded revenues, but mostly unrecorded expenses. These are the types of things that can only be recorded at month end. Things like depreciation expense, accruals of wages and other expenses, the use of a prepaid asset, and recognizing some revenue in certain situations. Adjusting journal entries do not involve an outside party. Everything we've done so far in this course, up to this chapter, we've done it in terms of another company, another employee via the payroll. We've bought things, we've paid bills. Here, we're looking at our own internal needs and recording the appropriate expenses or revenues. Think of adjusting journal entries as a hunt for unrecorded revenues and expenses. So let me see if I can share this now. I'm assuming that at the end of this video, when I play it, that you see this. If not, I've wasted another hour of my life, but we're here for you. I'm going to make it big. Okay, quality of earnings, adjustments, financial statements, quality of earnings. Who is responsible for the accuracy of the financial statements? It is management. Management. It is not the auditor's responsibility. It's not the accounting department's responsibility. It is management of the company. And in light of certain horrible accounting frauds from about 20 years ago that continued for a while with companies like Enron, WorldCom, and others, the law is now that management has to sign off that they've actually read and understood what they're presenting to the public. No longer can the CEO of a company say, hey, I don't know what's in these statements. I'm not the accounting people. Talk to Bob. No, those days are over. Management is responsible. The accounting cycle. We begin a business at a certain point in time, and we start recording transactions. Every day we come into work and we analyze transactions. We got a bill from a vendor. We need to write a journal entry to either record the payment of that bill or to just record the bill itself. And we record journal entries every day, and we post to the general ledger every time we prepare some journal entries. At the end of the period, after we're done with our final posting for the month, we print out a preliminary trial balance, a trial balance that we're going to call the preliminary. It's a preliminary because it's incomplete. It also can be 100% inaccurate. As you know, the only thing the trial balance does for us is prove that debits equal credits. And I don't think in this modern world where everything is done on some kind of computer or accounting system, you will ever run into an unbalanced trial balance. Not like in the old days when we used to do this in pencil. It was hell back then. Anyway, we get our preliminary trial balance, and now we've got to go through each item on that trial balance and see if it's in need of an adjustment. And we're going to record these various revenues and expenses. And once we've done that, we're going to print out the final adjusted trial balance, at which time we can then use that adjusted trial balance to prepare the financial statements, to get them out to the public, to banks, whoever are demanding or want to see them. And then at that point, we can take a breather, and the only thing left to do is close out the income statement. You close revenues, expenses, gains, and losses to retained earnings. And that's a whole process we'll get into, and the cycle begins again. As we should know now, we're doing accrual-based accounting. It means that revenues are recorded when earned. It has nothing to do with the cash payment. That's true for recording adjustments of revenues as well as adjustment of expenses. In fact, you will never see cash involved in an adjusting journal entry. It's impossible. Okay? Revenue and matching principles. Real important principle, probably the first one we need to understand. The revenue and matching principle simply says that revenues and expenses must be recorded properly and matched up in the right time frame. So at the end of the month, we're going to have to put in some more expenses or record some revenues that occurred during that time frame we're measuring and go from there. This is a key grid in your book. Types of adjustment, huh? Let's break them down into the two broader categories. Let's start with deferred expenses. I'm going to start with deferred expenses. These are pretty much your prepaid accounts, your prepaids. You purchased a $12,000 insurance policy at the end of 2019, and it's a one-year policy. It means that at the time we bought that policy, you had no insurance, and you still had no insurance until the new year began. So because of that, you can't take that $12,000 and consider it an expense. An expense is recorded when it's incurred, and that insurance policy goes into effect the following year. So when you purchased that prepaid insurance policy, you debited the asset account called prepaid insurance, debited it for $12,000, and you paid cash, say credit cash. We don't really care. So that asset at the end of the year is sitting there and it's worth $12,000. It is a valuable asset to have. Now, during the next year, you are going to be reducing that prepaid asset by $1,000 a month. And the journal entry will be a debit to insurance expense and a credit to that prepaid account, okay? Prepaid expenses, deferred. Let's go to deferred revenues. Another phrase for deferred revenues is unearned revenue. One man's prepaid expense is another man's unearned revenue. I purchased this $12,000 insurance policy from you, okay? And when I paid you, I put it into prepaid expenses, which is the asset. And then starting in January, I reduced that asset by $1,000 each month to record that portion of the $12,000 a year policy. Now, when you got my, excuse me, little happy fingers, when you got my money, you debited cash, okay? You debited cash. I, of course, credited cash. You credited an account called unearned revenue. Unearned revenue. Just what it means. It's monies you've received, but you haven't done anything to earn it yet. So just as I am recording an expense of $1,000 every month and reducing my asset, you are recording actual revenues of $1,000 a month and reducing this unearned revenue account, which is a liability. You don't owe me money, you owe me insurance company. You owe me insurance coverage, okay? Deferred. Another way to think about deferred, say to yourself, the service has been deferred. That's what's been deferred, the service, right? Under a deferred situation, money has changed hands, but nobody did anything to earn it yet. Deferred. Money changed hands, nobody's done anything to earn it. Let's talk now about accrued expenses. Accrued expenses. These are expenses that we have incurred. These are expenses that we do have to record because we did experience them. We did get the benefit of them. We did incur them. These expenses are those costs that do not involve any cash. These journal entries here for an accrued expense, we're going to recognize an expense and we're going to credit an appropriate payable account. A sweeping one could be accrued accounts payable. An accrual is a temporary payable. And in the case of perhaps the electric bill, this month ends July 31st. We're sitting around and we know we consumed electricity, but we look at our trial balance and we have no expense up there. I mean, we closed it out last month. We know there are no more expenses left and we have zero. How are we going to get that expense into the July financial statements? Do you think Bill Gates and Microsoft, when the world is waiting for their results, they announce to the world, well, we haven't got the electric bill yet from a San Jose Power Company? No, you have to accrue a number. You have to guess at the number, estimate the number. And the accounting term for doing that is on a systematic and rational basis. For example, out here in Southern California, not much leeway with the weather. So our electric bill's been running $1,000 a month, 1,100, went up to 12 one time. It's 1,100 last month. We can justifiably accrue maybe $1,200. Okay. We know it's not going to be exactly right, but it's going to be reasonable and right in the ballpark. And the entry will be a debit to the expense, utilities expense or electricity expense, whatever you want to call it, and accrued accounts payable or accrued utilities payable if you want to detail it that way. Accrued expenses. The other one that's the classic is the one you should all understand. You're all working men and women, I bet. You're out in the workforce, you get paid every 2 weeks. The month ends on the 31st, but that's only the first week of your 2-week assignment. You earned $1,000 from the 26th of July through the end of the month. That expense belongs in July, not 2 weeks later when your boss finally pays you. So again, you have to record salaries and wages expense and credit accrued salaries and wages payable, okay? The reason you have to accrue it is not just to put the expense in the proper place, but the liability as well. The company owes you that money on July 31st, legally and otherwise. If they fired you on July 31st, they'd have to hand you that check paying you through that day. Same thing if the company went out of business all of a sudden, or if you quit. Legally, they do owe you the money at that time. Well, when you were hired, they said, we're glad to have you aboard. I just want to let you know that our policy is we pay every 2 weeks and we hold back the 2 weeks pay. Is that okay with you? And you as an employee said, yeah, okay, I go along with that. So technically they still owe it though. Let's talk about accrued revenue, okay? Accrued revenue, they're calling it accrued receivables. This is mainly a situation where we're recording interest income. We loaned money to somebody, and the deal is we loan them $100,000 at 6%, which means they have to pay us interest every year of $6,000. They don't pay $500 a month. They only have to pay it at the end of each year, but the expense becomes $500 a month when we divide 6,000 by 12 months. And here we're going to debit a receivable called interest receivable and credit interest income, okay? So that's a quick look at that, and we'll go into it a little more detail here. 3 steps in the adjustment process. You look at every account in your trial balance and you say, does this thing need to be adjusted? Did we earn some revenue, or we have an unrecorded expense? Like I said, your adjusting journal entries are a hunt for unrecorded revenues and mostly expenses, okay? And then you get into the question of when does the cash come into play? And we're going to talk about that now. Revenue principle, huh? When cash is received on the date the revenue is performed or earned, there's no adjustment, right? This is Chipotle we're talking about. We asked them to cater a lunch today in the accounting department, and they delivered $500 worth of Mexican food to us, and we paid them right away. So there's no adjusting entry. They recorded the cash, and we're talking the revenue side. I'm sorry, what Chipotle would do. They debited cash, they credited revenue. Simple as that. What if the cash is received before they perform the service? Well, now we do have an adjusting entry. This is their unearned revenue. Chipotle got our check for $5,000, whatever it was, 2 weeks before the party. They debited cash, they credited unearned revenue, which is a liability account to be relieved when they actually feed us in 2 weeks. So as soon as the guy comes in with the food, they can recognize the revenue. And if we get paid, if Chipotle gets paid afterwards, well, your book is going to tell you this is an adjusting journal entry, but it's really not. The guy delivered the food and he handed us a bill to be paid in 30 days. We don't debit, they don't debit cash, they debit accounts receivable and credit revenue. When they say yes, an adjustment's needed, I really don't want to go there. The adjustment is collecting the cash, I guess. Let's go here. Back to the matching principle. Matching revenues and expenses. Revenues and expenses, not assets and liabilities. Has nothing to do with the accounting equation. Matching revenues and expenses. And again, here we go. The expenses happens to be incurred at the same time they did the work. Okay. Now we're on the expense side. Okay. We're the ones who catered this dinner, right? So they delivered the food to us. We recognize this in an account called tacos expense or something, and we credit cash. Simple. No adjustment necessary. Now we paid in advance. We paid in advance. So here is the classic adjusting entry. When we ordered the food, we debited prepaid expenses and credited cash. And when they delivered the food, only then can we record the expense. We record the expense with the journal entry you see below. You debit, in this case, some prepaid expense, and you credit the asset, okay? And here they're going to tell you it's an adjusting entry again, which I think is a bunch of baloney. And I don't think I've ever shown this to Cornelia or the other teachers. It's so corny. But here we go. The cash is paid afterwards. We pay it afterwards. So what? We debit the expense, which is the same debit no matter when we're going to pay it. And then we credit accounts payable. They're considering the payment an adjusting entry, which is not really an adjusting entry. I know you're not getting, you're going to get that journal entry on a test, but it's not going to be part of adjusting journal entries. Matching principle, huh? Matching principle. Now they're going back and they're going to review the different types again. Remember what we said. We have deferred expenses, the prepaid expenses, and their counterparts. And let's do it this way. We have the prepaid expenses. Prepaid and deferred are the same thing for the purposes of this. Okay? A deferred expense, prepaid expense, is an expense that hasn't been utilized yet. Deferred means money changed hands, but nobody has done anything to earn anything. Deferred expenses, right? Deferred revenue. That, of course, is your unearned revenue. Again, nobody's done anything, although they received cash in advance for some services. Again, no cash involved in any of these adjustments at all. The accruals, you might have some accrued revenue in the form of interest. You're going to have to know how much the note is, multiply it by the percentage, and divide by 12 to get the monthly number. I'm going to tell you this early. We're still a few chapters away from getting involved too heavily. But whenever you see a percentage on a note or a loan or just about anything, that is an annual rate and needs to be prorated into the appropriate number of months. The accrued expenses, that's that last week you worked, and you're not going to get paid for 2 more weeks, but the company recognizes your work with a debit to an expense and a credit to an accrual account of one type or another. An accrual account is a temporary payable, okay? And now we're back on this again. We're looking at this, I think, for the second time. Hopefully it makes a little more sense, huh? Now, now they're talking, they're repeating a little bit, but let's look at it. Accrued revenues, interest receivable. Interest receivable is a good example. We've earned the money. We loan somebody money, and every month his interest payment to us is building up by 500 a month. We're recognizing that build up as an expense every month. Unearned revenue. I'm the big sports fan here. I send the Dodgers my season ticket money. I send them a check for $12,000 for the next coming baseball season, as if there's really going to be one. And they divide that, they get that, they put that into credit, into unearned revenue. And when they start playing some baseball, they can recognize the revenue. And here's the expense side. Prepaid expenses, which I think are pretty easy, and the accrued expenses are always going to be a debit to an expense and credit to an accrual account. Okay, so when we started off with this presentation, they had that slide saying the accounting cycle. We process daily information into financial transactions. And in our course here, everything is done with a journal entry. So we're writing journal entries every day. We're doing all kinds of other things that don't necessarily go into the financial statements. We're doing balance sheet and general ledger analysis, and we're doing all kinds of reports for different departments. At the end of the month, when we're satisfied that we've entered everything we could possibly enter into the general ledger, it's time for what we used to call the cutoff. As of midnight, as of 11:59 on the 31st of the month, boom, we're done recording transactions. And what we're now going to do is print out our preliminary trial balance or unadjusted trial balance. And we do that, and the debits equal the credits, we can have a party because we're off to a good start. Keep in mind that that trial balance says nothing about the quality of the numbers. Every single number could be wrong, but the debits equal the credits, and that is our starting point. So let's take a look at Chipotle's preliminary or unadjusted trial balance at the end of March 17. They have so much cash, and they have some investments in other companies. Customers owe them this. And these numbers are in thousands. So they had $543 million in cash at the end of March. And just a slight digression, if I may, on the economy. One problem in the American economy right now is companies are hoarding cash like they never have before. There's just a lot of uncertainty. And when that money loosens up, and it will have to someday, that should be very helpful getting us back on our feet again. So anyway, we go through this, and I'm going to see a couple of things that you might notice. You see a couple of dashes. They have a dash next to wages payable and a dash next to supplies expense. How come? Because we can't touch those accounts until the end of the month. The end of the month is when we know how many hours people worked for the last week of the month and turn that into dollars for our journal entry. No supplies expense. That means that we have to figure out how much we've used of these supplies. And that's a lot of supplies, boy, huh? That's $385 million worth of napkins, straws, plastic forks, things like that. Things that are definitely an expense, but only when you use them. They're also of such a small amount per unit, you don't want to put them into the inventory. It has nothing to do with inventory. It's a prepaid asset. So we're going to have to count how many straws we have left and subtract that number from this 385 to get how many straws we used, okay? And that's not the last straw. You knew that pun was coming, I think. Oh, God, we got to look at this again, the types of... Okay, here we go. It's not quite a repeat of what we did. We're starting off with accrued revenue. This is probably your interest expense, okay? And what they're saying here is The revenues are earned every month of the calendar year. Let's pretend this is from January to December. But this company, Chipotle, wants to cut things off at the end of March to send out quarterly financial statements. So this $12,000 a year, 3,000, whatever the number is, goes there. So Chipotle's investments earned an additional $200 during the quarter. Wow, they have $543 million we just looked at, right? And they earn $200 a month in interest. My first thought would be I'd fire the treasurer of this company. What is he doing with all that cash? Anyway, so at the end of that quarter, we're not getting any cash from the lender, but we have to recognize with a journal entry, a debit to interest receivable, 200, interest revenue, 200. Interest receivable at the beginning of the month had 0, and now there's a balance of 200. And on the interest revenue side, they had already recorded $1,200 worth of interest from other lenders, perhaps, and now they're layering this 200 on top of there. Accrued revenue. On the test, you might get a question where they'll give you a loan amount, $20,000, 3%, that would be $600 a year or $50 a month. That interest rate always represents 12-month period, okay? Now, let's look at the unearned revenue. The unearned revenues, your gift cards. You are Nordstrom's, and you're always selling gift cards to the public. And when you do that, you're going to debit cash and credit unearned revenue. And then when the person comes in and uses it to purchase something, now you've got real revenue. And I'm going to digress again, just a moment here. Do you think companies like it when they sell these gift certificates and then people don't use them? Do you think they're glad? They say to themselves, wow, this guy gave us $200 and he never showed up again. That's great. Not really, because they obviously want you to come into the store with your gift certificate, knowing you're going to be buying something else. It's just human nature. No, they want you to use the gift certificates. And I don't know if you guys had to do the article on the accounting for gift cards, which has changed fairly recently. I think that's the most interesting article of all the assignments in my world. Deferred revenue, $17,300. Let's look at your journal entry. They had, when customers redeemed during the quarter, they provided service in this amount here, $17,100. So there's your revenue there. And here, they're reducing this beginning balance here. This is your beginning balance, credit balance. They're reducing it by 17.3, 21.4. Okay? Unearned revenue. You debit some kind of, you debit the cash when you get it, credit the unearned revenue. And now at the end of the month, your adjusting journal entry is to record the revenue with a credit and reduce this unearned revenue with the offsetting debits. And here we can look at the journal entry. Now we're getting into the other two types, the accruals and the prepaids. And these are the ones that make up most of the activity. Okay, they want to start with the deferred or prepaid expenses. And the examples are obvious: prepaid rent. Again, we paid for a policy that covers these 12 months, and that policy was $72,000, picking a different number, $72,000 or $6,000 a month. You multiply that by the 3 months, that would be your number here, okay? So here is where we're building this up. Here is when we're gonna record, and at the end of the year, that asset account will be down to 0. So let's take a look here. They had a beginning balance of 150 in the prepaids, whatever they were. and they have this other expenses and loss account. I just want to take one more look at this here. Okay. Insurance, rent, other prepaids expired in the amount of $93,400. Make sure you read those verbs properly. On the test, you'll be given a simple bunch of numbers, but it's easy to misread the problem. They said here the amount expired. Expired means that's the expense. So that's going to be your debit to the expenses here and a credit to the prepaid, I bet. Okay, so let's see here. There it is. There's your debit to other expenses, and there's your credit to the prepaid, okay? Another way they might word a problem with this, they'll change the word expired to on hand at month end. On hand. On hand means that's not the expense, that's how much they had left of that prepaid asset. And you would have to subtract that from the beginning number to get the proper number. Expired, on hand, consumed, just read it carefully. And there we go. Now the prepaids. Another prepaid example here, I guess. Supplies were used. No entry has been made. Now here's what I'm talking about. Here, they're not giving you the expense. They're giving you what was on hand, what was left over, okay? We had a big number sitting there. We had something like 389,000, I think. So let's take a look here. It was 385,000. That's how many straws we had on hand on last period. That's how many straws we had at the end of the month. And this really should be called prepaid supplies. When you see the word supplies by itself, that's the asset, prepaid. And when you see expense afterward, I'm sorry, keep clicking on this thing. Okay. So here we had to take that 385 and subtract 16,100 to come up with the expense of 369,000. Huh? Remember, that's 369 million. It's a big company, Chipotle's. Here we go. Here's your other prepaid, not prepaid, your deferred expense, depreciation expense. This is the one you should always be hoping is on the test, because the debit and credit is always the same, no exceptions. You're going to debit depreciation expense, and you're going to credit an account called accumulated depreciation. Accumulated depreciation is what's known as a contra account. Contra, from the Spanish word contra, which in English means contra. It means the opposite. It means a contra asset is an asset that carries a credit balance as opposed to the normal debit balance. It's an outlier. And whenever you have a contra account, it's always married to something. In this case here, that contra account is married to the cost of the asset, okay? And the difference between the two is called net book value. And that net book value gets lower and lower every year we depreciate. You will never credit a fixed asset account unless you're selling it. So you buy a piece of equipment, and that piece of equipment lasts for 50 years. Whatever you paid for it, in this case, it's 476,300. That number will stay there in perpetuity. It'll be there forever, unless you get rid of the equipment. So here we go. It's an adjusting entry. They had no expense to begin with. They still have that much in accumulated depreciation. There's your journal entry. Depreciation expense, accumulated depreciation, contra asset married to, in this case, the equipment. Okay? So $476,300 minus whatever the accumulated depreciation was will give you the net book value. Okay? That one I don't think is too. Did I see a misspelling error here? No. Okay. Accrued expenses. Here we go. Here we go with the payroll. We have to accrue this. As of 3/15/77, Chipotle had already paid 177,000 in wages for this period, huh? That means that this is wages. This represents wages that have been earned and paid, most likely at this point. This is the work that was done from the beginning of the month to the end of the month, huh? Chipotle pays every 1st and 15th. The employees have earned total wages of $67,200 for the last 2 weeks, or the last half of the month, huh? So we have to accrue something here. We have to accrue something. Let's take a look at it. Here's the wages expense. That is from earlier in the month. There's no wages payable yet, nor can there be. Here's our adjusting entry. We debit wages expense or salaries and wages expense, whatever the company has, and we credit wages payable. Again, that $67,200 is a legal and accounting liability at the end of the period. That company owes you that money that day. You're just being a nice guy because you agreed when you joined the company that you would wait a week or 2 weeks to get paid. Okay? So now we have the appropriate payable on here, and we've got a total expense down there now. Chipotle owes a total of $287,900, huh? They borrowed money, and that money is costing them an interest, $2,400 a year. Do you mind if I go to the old clicker here? I'd just like to point something out. Oh, here we go. $200 a month. That's $2,400 a year on a loan of $287,900 equals 0.008. Somehow they managed to borrow money and they're paying interest of less than 1%, which is pretty darn good. Let me know if I can borrow some money that way. I usually have to pay big money from the local payday lender, if you know what I mean. Accrued expenses. Okay, $200. Again, that's a great interest rate if you're the borrower. The only people who would loan money that cheap would be money launderers or something. Okay, accrued expenses. Again, accruals mean we have experienced the expense or revenue, no money yet. Deferreds, we paid in advance or collected in advance, but we can't recognize any expense or revenue yet. So here we go. We're back to that trial balance again, huh? And note, the debits equal the credits. That's wonderful. Every one of these numbers could be wrong, but that's part of the closing process. Where I worked for many years, the closing could be anywhere from a couple days to a week. I was with a company for a couple of years, long time ago, where they closed like in 30 days. We'd be getting ready to finish the month, and we still hadn't finished up the prior month. But that was a private company, small. They weren't that worried about it. Okay. Here's that same trial balance. This time, though, we have hints. We have grids set up now, these rectangles. And hint, what they're apparently telling us is we're going to need adjusting journal entries to affect these accounts. And let's start with the expenses. Yeah, I don't see any wages expense. I don't see any interest or supplies expense, huh? So we know we're going to have to hit those. And we know if we debit wages expense, we're going to have to credit wages payable. And if we accrue interest expense, we're going to have to credit interest payable. Same thing with the supplies. Supplies, well, we know we used some supplies, and we have to now record that. So let's take a look here. Now, here is our adjusted trial balance. How about that? This thing is now perfect. It's blessed. And what it means is that our accounting department did their due diligence, and they verified the cash as best they can. Perhaps they were able to do a bank reconciliation or do something to verify that number, the comfort of it. Short-term investments. Chipotle had money left over to buy certain stocks in other companies, and here we go. We've got a totally perfect trial balance. Now we're ready to start doing the financial statements, huh? But I want to take us back here. This is the Bob trick. Are you ready? You see where it says revenue, the first revenue line? Get in the habit of putting a little horizontal line here. Separate the retained earnings line from the first revenue line. And the reason for that is everything below the retained earnings line is your income statement. There's your income statement right there. You had sales of food for $10.89. They earned the whopping interest of $1,400. And then you subtract all the expenses. Everything above it, starting with retained earnings, is the balance sheet. And you're going to mostly just copy these numbers over with one exception, and that is the equity account mostly, okay? So now we do our statements in the proper order. Income statement. We have to get the income in order to do the equity statement. We have to get the equity in order to do the balance sheet. And then we can do a statement of cash flows, which we're really going to do in about 10 more chapters. That's toward the end of the class. Financial statement, they have relationships. Did you know that? The income statement has a relationship with the other two. It's like a triangle. The income statement is created first, revenues minus expenses. And where does that net income go? It's going to go into retained earnings via your closing entries. So at this point, we've created the income statement. We know what our net income is, and that net income is going to end up going into retained earnings. Net income increases retained earnings. Dividends reduce retained earnings. Dividend is you're giving away ownership in the company to somebody, okay? You're giving away ownership in the company. Financial statement relationships, huh? Now that we know what the net income is, we add that to stockholders' equity account called retained earnings. Maybe this company issued stock. Maybe the owner of this company threw $50,000 out of his own pocket. All of that also increases overall stockholders' equity. But retained earnings is where your net income flows every month. And again, the way to think of retained earnings is the company began business January 1st, 1946, after World War II. And at that point, he had no retained earnings. At the end of the first year, they made a profit of $50,000. So retained earnings became $50,000 credit balance as an equity account. And they kept earning profits. And to this day, this retained earnings number represents the total of all the gains and losses that company has incurred since the beginning in 1946. Now, finally, after all these years, they may give out a dividend, which would reduce the equity. Closing entries. Closing entries. Even though the balance sheet account balances carry forward period to period, the income statement accounts don't. Did you know that? Well, you should know it now, huh? At the end of the, let me just look at something here, I'm sorry. At the end of the period, we have to zero out everything that's on the income statement, meaning the revenues, expenses, gains, and losses. And we're going to do that and move that net income to retained earnings, leaving a zero balance in those accounts going into the next month. Closing is called closing the books. You've heard that expression, closing. Gotta close the books. Anything on the income statement is a temporary account. Temporary. It only lives as long as the accounting period, which in this case is 3 months. Normally it's 1 month. Companies do this every month. You have to record zeros in every single one of these guys, and that they go over to retained earnings. They suggest a two-step process, and they're exactly right. Makes it a lot easier. As long as you keep in mind, the purpose of closing entries is to eliminate the income statement items by writing a journal entry that reduces them to zero. Do the revenues first. In this case here, this company had two revenues. They had the big one from selling food, and then the $1,400 from interest revenue. They have normal credit balances. So you would debit those two revenue accounts, and credit retained earnings. You do the opposite for the expenses. Expenses, as you now know, have a debit balance, a normal debit balance. So you're going to credit every single one of them and then debit retained earnings. At that point, you now have moved the income into retained earnings into stockholders' equity. Okay. If we were to close Chipotle's temporary revenue accounts, what would it be? Well, we know they had two revenue accounts. Take a look at it. The revenue was 1089. We got to get rid of it. We get rid of the revenue with a debit, and we increase retained earnings with the credit. Retained earnings is part of stockholders' equity and thus has a normal credit balance. Do the same thing with the interest revenue. You debit it, and then you move it over here to the retained earnings, okay? Two steps. First, do the revenues. Now we do the expenses. Again, all you do is go to that finished trial balance. Not too tough. Not too tough. Start with the second line because you know you're going to end up debiting retained earnings. But you list all the expenses. You credit them all, which means we have nothing left at all in revenues and expenses. And this debit goes to retained earnings. When we closed the revenue, give me one more second here. I just want to go back. Never mind. We got rid of all these expenses with a credit and debited retained earnings. The revenues, of course, increase retained earnings. Every time you sell something, it will increase your equity. Every time there's an expense incurred, it goes the other way, okay? And that's what we're talking about. We got rid of these wages with a red here, with this credit, debit over here. This is just another grid you might use. I don't particularly like it. It is a shortcut. You know, there's probably some smart eggs in the class that might use this, but you still have to end up writing. You still have to end up writing the journal entry and posting anyway. Okay, so now we're getting to the end of this chapter. We learned all about adjusting journal entries, and now we learned about closing entries. The last and final thing we need to do is print out what's called a post-closing trial balance. After all the temporary accounts have been zeroed out, we prepare a post-closing trial balance. Only assets, liabilities, and equity are going to appear on this. We've zeroed out everything else. So there's a blank post-closing trial balance, huh? I guess that's pre-post closing. Look at your closing trial balance now. Post-closing trial balance. I see assets, goes in the proper order, assets, then your liabilities, and then your equity. On the post-closing trial balance, there are no revenues or expenses. That changes 2 seconds into the next business day, as soon as somebody, sells you something or whatever. These metrics are going to be taught primarily through the FSAs. Let me talk about that for just a moment. The FSAs, financial statement analysis. That's what I'm trying to say. Financial statement analysis is the way we're going to go learn these. There's a whole chapter just on the metrics, but we're going to do most of them through the FSAs. And I want to show you this one. This is a typical easy one. If you take the net income and divide it by the net sales, you're going to come up with a percentage. And in this case, the net income was 103 million. And if you want to verify that number, go back to your adjusted trial balance and quickly do an income statement. Just take the income on the right, add them up, and subtract the expenses. So Papa John's earned a profit for that quarter of $103 million on sales of $1,710,000. They earned a profit of 6.02%. This means that for every dollar of sales, they retained 6 cents, 6.02. Is that a good profit? I guess it depends on the company, the industry, and the expectation and the size. 6%, that sounds pretty good to me today. If Papa John's took this if they took this $1,710,000, $710 million, and put it in the bank for a year, they wouldn't even get 1%. So they did 6 times better by be willing to take a risk and run a business. That's what the whole economy is about, huh? So, having said that, I'm going to get on my sailboat later, and that's right, I got to pick up my surfboard tomorrow. It's being waxed. Okay? Anybody have any questions? That's what I like, silence. Okay, I hope this helped you, and I'm going to leave this up on Canvas, okay? Hey, take care, everybody. Thanks for listening. Bye-bye.